Hello and welcome to my YouTube channel, the Corcoran Codex. My name is Clive Corcoran, and here we consider and analyze many very interesting critical ideas in the world of finance. What I want to focus on in this screencast relates to value at risk, or VAR, and perhaps more specifically I want to eventually look at what is known as tail risk. Now, value at risk, or VAR, measures the potential loss in the value of a portfolio or trading book over a defined period for a given level of confidence. So let me give an example. Let's supposing that one has stated that the VAR for a particular asset is $100 million at a 1 week horizon with 95% confidence. What in effect is being said is that there is only a 5% chance that the value of the asset or trading book will drop more than 100 million over any 1 week. So in effect, one could translate that and say 19 weeks in 20, the losses will not exceed this number, 100 million, but 1 week in 20, they will. And it's important to note what the VAR proposition does not say. It does not tell us what the loss might be for that 1 week in 20. So there are essentially three key elements to any kind of VAR statement. One is the specified loss in value. In this case, it's $100 million. A fixed time horizon over which the risk is going to be assessed, and a confidence level. In this case, it's 95%. Now, for example, in the world of banking regulation, banks are required to calculate a metric along these lines over a 99% confidence level. The next question I want to pose is, how has VAR, value at risk, been calculated historically? So for market risk, the starting point is to calculate the standard deviation, essentially the variability of the outcomes or trading returns in a portfolio of securities or a trading book over a specified period. So effectively what is being measured is the volatility of these returns. Now, the granularity of the VAR requirement, in other words, you've been asked to provide a VAR statement, and then you're told what is the event horizon, or what is the period, dictates how often the outcomes are sampled. There are approximately 250 trading days in a calendar year, so if we were required to give a daily VAR statement, we would need to look at all those 250 returns during the course of a calendar year. Now, the formula for VAR, as it used to be calculated, or has been calculated historically, is shown on the screen. So the value at risk for a portfolio P is equal to alpha multiplied by sigma P, which is the standard deviation of the portfolio or the returns, multiplied by the value of the portfolio. So there it is, the portfolio value, standard deviation of the returns. Now, the alpha value is the chosen VAR percentile, value at risk percentile, in other words, the 95% or the 99%. And where we can find that is by making a reference to the standard normal distribution, and we would then calculate, and then we would identify what is known as the standard normal deviate for that percentage, sometimes known as the Z value or Z value. I've said a little bit already about the standard normal distribution, so let me say a little bit more. Now, basically, this is the famous bell curve, and all of the clever probability theory associated with the bell curve was developed 200-300 years ago by a famous German mathematician, Carl Friedrich Gauss. Basically, what the bell curve shows is that if the data that is being analyzed is subject to a normal distribution, more to be said about that in a moment, then there are some remarkable probabilities associated with the outcome or the distribution of the outcomes. So for example, if we create a distribution. This value here in the middle, this is the zero value effectively. This is the mean of the distribution, the average value in our distribution. If the value is at the mean or the median, then obviously it would tend to have the highest probability of occurring. Now, the next step is that if we move one standard deviation to the left or one standard deviation to the right, the area under the curve here actually corresponds to just a little more than 68% of all of our outcomes. So what one could say loosely is that 2/3 of our outcomes or data points should lie within plus or minus one standard deviation of the mean. If we extend this out to plus or minus two standard deviations, we are now focusing on 95% approximately of our distribution, and between -3 and +3 standard deviations, we are more or less reaching the limits of our data. About 99.7% of our data should lie within that interval between -3 and +3 standard deviations away from the mean. I made the point a moment ago that the bell curve really is only accurate in terms of those percentages and probabilities I've mentioned if the underlying data is normally distributed. So let's actually look at data which is normally distributed. So I'm going to use as my example the heights of adult males. Global studies have shown, and there obviously are regional differences, but essentially it has been shown that the average height of an adult male is approximately 175 centimeters or 5'9". There are regional variations, but essentially these numbers are fairly robust on a global basis. Now, the standard deviation, in other words, the dispersion around the mean based on global sampling and so on, shows that the standard deviation is approximately 6 centimeters or roughly 2 inches. So just to go back to the diagram, we could say that if this now takes on that value, the 175, we subtract 6, so we're down to 169, or we add 6, so we go to 181. 2/3 roughly of the men that we would randomly sample should lie in that interval between those two, and 95% should essentially lie within the -2 to +2 standard deviations. With that in mind and the probability associated with this particular statistical distribution, we can go on and say, well, how would we find what is known as the Z value or standard normal deviate for a given confidence level? And the answer is that there is a very useful function in Excel. You can see it here, normsinv, which refers to the standard normal distribution and returns the Z value for a given confidence level. In a sense, it's used to describe how many standard deviations away from the mean a given value is. So let's say we want to look at 95% confidence, as we were discussing a few moments ago. We plug in 0.05 into the function because essentially the distribution is symmetrical, and we're actually focused over here in the left tail of the distribution. For example, this is where losses would arise if we're depicting the outcomes, daily returns from a trading book, for example, and basically it gives us this value of 1.65. So in this case, 95% of our outcomes, our daily returns if you wish, will be to the right of this number here, and the remaining outcomes will be in the tail of the distribution, the left tail. This is the 5% shaded area. Now, all that I've said so far relates to how value at risk was calculated for decades, but in more recent times it is now widely accepted that market data, the outcomes from day-to-day performance, the ups and downs in markets, do not follow a normal distribution. One author that has pointed this out is Nassim Taleb, and he wrote a very good book here back in the 1990s, I believe, Fooled by Randomness, which I read many years ago, found very, very interesting. He then popularized the underlying idea here of the black swans in a book that I would not really recommend. What Tyler basically said was that there is tail risk within markets, that whereas, as you saw a moment ago with the bell curve, 99.7% of all outcomes would essentially lie between plus or minus 3 standard deviations from the mean. Empirical evidence shows that that is not the case, and that you can have extreme outlier events, some of which could be up to 20 plus standard deviations away from the mean. None of that is contemplated within the Gaussian theories associated with the bell curve. In order to popularize his idea, he referred to these outliers or tail risk events as black swans, based on the idea that for centuries people thought all swans were white, and then when reports came back from distant lands that there were in fact black swans, people had to adjust their thinking to include the idea that swans could be black, and he points to that being a similar story for maybe how we as human beings must adjust our thinking about tail risk or outlier events. Now, one point that I want to make down here, which is often actually overlooked in this discussion, is this question: does it make sense to talk about a decline in tail risk? Sometimes one hears commentators saying, well, tail risk is in retreat, or we don't believe tail risk is or we don't believe that tail risk is a real issue at the moment. And the idea is that tail risk does not decline. It is always present. It is imminent, to use a technical term. It does not decline. It is always present and could emerge in some sudden, abrupt tail risk event. Just to clarify the distinctions that I've kind of made within this screencast, let me illustrate now why this tail risk idea is so critical. Now, what I've done here is I took the S&P 500, I actually used the ETF, the SPY ETF for this, and I focused on the year 2020, this of course being the year when the COVID pandemic began. And what I did was I took all of the daily closing prices here during 2020 for the S&P ETF, as I've said, and calculated the day-to-day change, the percentage or log change between the prior day. And then the final thing I did was to rank these percentages here such that the worst daily loss appears here. Now, this happened to be on the 16th of March 2020. This was when basically governments around the world were advising their citizens to go into lockdown and so on, and we had a drop from the prior day of 11.5%. And then the second worst loss was this day here, very similar, very close by, 10% drop, and so on. I then created a frequency distribution over here, which doesn't look like the bell curve. As you can see, there's a very narrow, it's not really fair to call it a bell at all. We have this rather narrow clustering here around the unchanged effectively, and then we can see this is moving out percentage-wise. It's also moving out in terms of standard deviations and so on. The essential point I want to make is the following: that if we calculate the parametric VAR, that is essentially the one based on the normal distribution, the Gaussian assumptions that I've mentioned and so on, at 99% confidence over a one-day horizon, so in other words, the tail would only be 1%, and we use the standard deviation, that's the sigma value there, we use the mean and so on. Basically, it tells us that we should expect essentially one day in 100 a loss of more than 4.9%. 99% of the time the loss will be less than that. Let me now turn to the more robust method that, for example, is now required in the world of banking regulation and so on, and I'm referring to this for current purposes as expected tail loss. And we want to calculate what the expected tail loss at the 99% level is. How might we do that? Well, let's think in terms of the number of data points that we have here, And if it's 1 year's worth of data, in this particular case, in 2020, there are 252 daily returns. You can see some of them here. Now, essentially, we're focusing on the tail, which would essentially be the 1% beyond that. So we can take 1% of our 252 observations, and that comes to 2.5. Well, we can't have 2.5 observations, so round it up to 3. And essentially, the expected tail loss with 99% confidence is the average of those 3 there, the worst losses over the 1 year horizon. And we can actually see them here. There they are, these 3 here. And when you average those 3, the actual loss is very close to 10%. So what we are seeing very clearly is that the parametric VAR, the method that is based on the incorrect assumption that our data is normally distributed, underestimates the true value at risk based on the empirical data by about 50%. So we have a value closer to 5, whereas the actual empirical data shows us that the value should be more or less 10%. So I hope you found that explanation and analysis of tail risk to be helpful, and I would hope that you will revisit my YouTube channel again from time to time, the Corcoran Codex. Thanks very much for watching.